Morning, everyone. It's Ben Buckner and Dan Bosse with Ag Resource Company in Chicago. It's Wednesday, July 30th. We've got markets once again kind of steady to weaker. Trend continues. We've got the Federal Reserve decision later this afternoon, and I think maybe partially because the U.S. economy grew by better than expected 3% in Q2, they will very probably leave rates unchanged. Otherwise, it's more of the same. We will dig into weather, and we are sort of getting some news on trade deals or lack thereof. And of course, the August 1st deadline is just 2 days away. So, Dan, what are you seeing this morning? And do you see anything that changes the general trend that we've seen?
No, I wish I could say I could find something, Ben, that changes us into a more bullish mode, but I don't see it here today. The U.S. announced that the Chinese, of course, will probably extend the tariffs for 90 days. That's the expectation. Trump could get a little more angrier, if you will, and maybe raise tariffs again to try to push the Chinese in a direction. But I think we're now waiting until Trump and Xi meet in late October. That would be October 31st and November 2nd. So that's where we're at that. But, I need to think that all of us will like to look at trade as being now less positive going forward. Trump announced here this morning that the U.S. will impose 25% tariffs on India as of August 1st. Now, India was one of the hopes for the U.S. agriculture that indeed we could find some additionality in terms of corn imports, maybe some ethanol, maybe some wheat, soft red winter or hard red winter. That now seems to be off the table. So tariffs will be imposed there. The Indians are not big, how should I say it, importers of U.S. ag goods. We know that already, but it's a market that's growing very large. And the expectation is longer term that this was supposed to be a significant demand driver, much like China was looking backwards 20 years ago. So we now have to wait. The culture of India is one of protection, and I don't see any way that this is going to change. And so a disappointment, though, again, it's from a broad perspective, nothing nearby. As you think about the markets and what happened in the recent days, and we start to go backwards and think about where we're at on things, the Chinese and the U.S. trade agreement did not get worked out. So this is a graphic showing you the September-December corn spread. And that spread has pushed out now to something like 22 cents. That spread has been widening for much of the last 3 to 4 months. You can see in this graphic here that we are down at historical level. We typically don't get these corn spreads this wide, at least heading forward. But as we've mentioned a couple of days ago, the Louisiana harvest is moving along. We're seeing harvest across the Gulf. We're seeing things happening in the world import market, where likely Mexico is going to be one of the only remaining customers for U.S. corn. We don't see any new demand forthcoming. And with the EU, it's going to take a lot of time, and they have a 17 million metric ton larger wheat crop. So when we look at world corn supplies, it's Brazil, it's Ukraine, it's the United States. There's abundance everywhere. And with that in mind, that's kind of where we find ourselves in the spread. And the spread is telling us directionally where the corn market is heading. Also, we've seen a real drop, if you will, in the September-November bean spread. So this spread is reflecting where that spread is sitting at in terms of looking forward. That spread is kind of, given us an indication that the Chinese are not going to be here for the, of course, new crop season. Now, this spread, all of these spreads in Chicago are based on what we consider to be the Gulf. And so when you think about the Gulf going forward, the Gulf looks like it'll have a rather modest program starting out the new crop year on soybeans. This is why that spread is moving out. We would expect deliveries against the August contract as we get into first notice day in terms of old crop. As we move into the new crop harvest, again, there will be abundance forthcoming, and that's where the real concern is down the road. As you look at the oil share spread, you can see here that we are now up against 52%. So this is a discussion this morning. We're spending a lot of time talking about spreads for good reason, whether it be the September-December corn spread, September-November bean spread, or now the oil share spread. You can see in this graphic here that we are up against historic highs. This is the highest level that oil share has been looking backwards in time. Now, we did see the same level back in 2022, and soybean oil prices reached over 90 cents a pound. However, now we're in this position where meal prices are dropping. This oil share spread is high. I would say the soybean market's going to have difficulty rallying unless we get some bullish news, whether it be the 45Z program from Treasury, or maybe, of course, we get indications on SRE or small refinery exemptions from the EPA, but it's going to take additional news on the bull side to get the soy oil market moving to an even higher level. So I think you're going to see profit taking on the soy oil market and profit taking in the spread relative to soybean oil relative to meal. U.S. crush is sitting at a high level. We're looking at our best level in crush, $217 or $2.17 a bushel is the best that we can see looking backwards to last August. So processors of soybeans are making money, and they will keep their bids for cash beans moving higher. So if you're looking at selling cash beans, don't look to the river, look to a processor. That's where your best bid will be. And as we think forward, that's where the opportunity is in terms of the market and building demand going forward. But again, you can't replace China. I think that's the message I would leave all of you. We think China's bought 6 to 6.5 million metric tons of South American soybeans for October. Now, they are paying above the U.S. Gulf, but again, remember there's a 10% tariff on U.S. soybeans or grains heading into China, so that premium makes a lot of sense. The Brazilians are still cheaper when that tariff is included. But oil share here and is likely peaking, and soybean crush margins, hard to say they're going a lot higher, much more than, let's say, 230 or 240 a bushel, at least in the short term. Lastly, we'll finish up on weather here. This is giving us the idea that the first 10 or 12 days of August will be cooler than normal across up of the much of the Midwest and the plains. We're also going to see a pattern where we start to see less rain. I personally believe that less rain is positive because we've seen an abundance of rain through the northern plains, up and through the upper Midwest. Crops, and particularly soybeans, don't like wet feet. So this drier trend should be helpful to yield potential as we look over the next, let's say, 10 days, maybe into the middle of August, Ben, before we really start to want to see the rain turn back on again. So everything weather-wise still looks very good for the U.S. crop, and I see no reason why yields are talk will still not go head higher.
Yeah, I think that makes sense. And I think I agree with you. It's rained a lot in Nebraska and Iowa, especially. And we got another 36 hours where it's going to be pretty wet there and in Missouri and Illinois. So like even 10 days of sunshine probably welcomed. And so to be pretty concise here, I think it is, we could have maybe 100 million bushels of corn harvested in the Southeast, in the next, 15 or 20 days. So that's what we're contending with. Seasonal trends are not just digesting possible future, but kind of the reality of this new crop supply. So again, every day we're looking for reasons why we'll see stability in the market. It's just kind of hard to identify that now. And now we're dealing with some trade policy issues. Also this week, again, $1 gets you in. We are going to give you our by state and national U.S. yield forecast. So we'll tell you what we think, and I think more importantly, why we think that, so you can see what very likely we're dealing with ahead of the USDA's August WASDE. So any final words before we sign out, Dan?
No, Ben, I tried to highlight spreads. I think spreads will give us the answer in terms of when markets turn. And right now, there's nothing to indicate that there's a turn ahead of us. So September spreads are very weak. It's showing us that the demand trends, at least heading into harvest, aren't there. And I think that's key. And I want to lay that with anybody watching this video, that we need to see a change in the spreads before this market will start the bottoming process.
Yeah, very wise, very insightful. So as usual, all the best in the markets today, and we will be back tomorrow with brand new information. Thanks.